Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we're doing a deep dive into something that feels like, well, a puzzle in global economics, a real physics problem almost.
It really does.
We're looking at China and Taiwan, two of the biggest export giants out there.
Huge.
And their currencies, the yuan, the Taiwan dollar, they just aren't appreciating as much as you'd think. Not with these massive continuous trade surpluses.
That's like economic gravity is just not working. I mean, for anyone listening, the basic rule is simple, right?
Yep.
If you sell tons of stuff to the world, you get paid in dollars. Those dollars flood your system, and people have to convert them to your local currency.
Which should drive its value way, way up.
Exactly.
And the pressure here is immense. I mean, we're looking at data showing China's trade surplus for just the first 11 months of 2025 sailed past $1 trillion.
A trillion. It's an incredible number. That's a historic flow of foreign currency coming in.
Yet when you look at the official foreign exchange numbers, they seem stable, almost modest sometimes. It doesn't add up.
It doesn't. And that's our mission today. We're going to look at the invisible hand, the non-official plumbing these governments are using.
The hidden channels.
The hidden channels, the structural levers, everything that's absorbing these massive dollar flows. And, crucially, what it all means for investors like you.
Okay, let's unpack this, starting with China. The central bank, the People's Bank of China, isn't just openly adding $1 trillion to its main reserve account. So where's it all going? Who's doing the work?
So the answer is that China has this really sophisticated two-layer strategy, and it's designed to give plausible deniability to those official numbers.
2 layers, okay.
The first layer is tactical. It uses the big players in the financial system.
Major state-owned commercial banks.
Exactly, the big four. They're basically acting as the central bank's proxy arms.
So how do they intervene without the PBAC itself, taking the hit on its balance sheet right away?
They do it through what analysts call two-way management. They're in the market, actively buying U.S. dollars, both in the spot market and the swap market.
Okay, and for our listeners who might not be deep in the FX weeds every day, could you just quickly break that down? Spot versus swap. Why are swaps so sneaky for this?
Sure. Spot intervention is simple. You're buying dollars now for immediate settlement. It hits liquidity right away, and it's pretty visible.
Hard to hide.
Very hard. Swaps, on the other hand, are different. You agree to exchange currencies now, but you also agree to reverse that exchange later.
So it's temporary.
Exactly. It lets the state banks soak up all that dollar liquidity today without permanently increasing their own holdings or the central bank's official reserves. It's like you're leasing the dollar flow, not buying it outright.
Which perfectly masks the immediate scale of what they're doing.
It does. And we saw this in reports from late 2025. State banks were buying dollars even when the yuan was already really strong, near a 14-month high.
So this isn't just about defending against weakness. They're actively putting a ceiling on the strength. They're managing the speed of the appreciation.
Precisely. And you have to understand the rationale behind it. In China, domestic demand is, well, it's structurally weak, so their dependence on exports is incredibly high.
So if the yuan suddenly skyrockets, their export engine just seizes up.
It puts the brakes on hard.
Okay.
So preventing that sharp appreciation is a defensive move. It protects the one thing that's really filling their growth gap right now.
Okay, so that's layer one, the tactical side. But you said there's a second layer, the structural one. This is where it gets really interesting, right? This idea of structural opacity.
Yes. This is the invisible intervention that people like Brad Setzer at the Council on Foreign Relations have pointed out for years.
Structural opacity, what does that mean in practice?
It means China deliberately holds its foreign assets away from its own main, clearly labeled central bank account. Think of it this way.
Okay.
Instead of keeping all your savings in your main checking account where everyone can see the total,
Right.
you hide huge chunks of it in different safety deposit boxes. And those boxes are controlled by different people, different trustees.
So you can't just look at one account and know the real number. You're spreading it out to make it harder to track.
You got it. And we can see the breadcrumbs in the U.S. Treasury data. When China wants to buy, say, $50 billion in U.S. Treasuries, they don't just lag it under the China mainland entry.
Where do they log it?
They route the purchases through these overseas custodians, these investment structures in big financial hubs.
Like where?
The UK, Luxembourg, and especially Belgium.
Belgium. Why Belgium?
It's home to Euroclear, a massive clearing and custody center. So by funneling these huge dollar flows through these hubs, they create a visibility problem.
So the official reserve stats look smaller, more stable, The real accumulation of dollars looks much less aggressive than it actually is.
It's a deliberate blurring of the lines
Yeah.
between official reserves, state bank assets, and sovereign wealth fund holdings.
Which must be a massive headache for investors who rely on that official data.
A major headache, especially in the U.S. Treasury market. If you see the China mainland holding of treasuries drop, it doesn't mean they sold.
It could just mean they moved the assets to an account in Brussels?
Exactly. So that reduces the fear of, China's going to dump all its bonds and crash the market, but it massively increases uncertainty about who really owns what, especially in a crisis.
And the end result of all this maneuvering, tactical and structural, is that China keeps exporting a tidal wave of cheap goods.
Which is disinflationary for the rest of us. It's great for U.S. consumers and helps keep interest rates down, but it's brutal for any industrial competitor trying to compete on price.
And that leads right to the political angle. I mean, the IMF has already warned that this kind of strategy just invites blowback.
It guarantees political friction. As an investor, you can't just look at China's manufacturing efficiency. You have to price in the risk of that political price hitting.
New tariffs, new regulations.
Yeah. And that doesn't just impact China. It sends ripples through global supply chains, hitting everyone from Korea to Europe.
Okay, let's pivot now to Taiwan. They have the same core issue, right? A massive current account surplus, sometimes getting close to 20% of their GDP.
It's enormous. By all rights, the Taiwan dollar, the TWD, should be one of the strongest currencies in Asia.
But it's not. And they use a completely different tool. It's not the state banks. It's their insurance industry.
It's fascinating. Where China uses opacity, Taiwan uses just sheer mass and structural incentive.
What do you mean by sheer mass?
The key is Taiwan's life insurance sector. These companies hold foreign assets that are comparable to the country's entire GDP. We're talking around $700 billion in overseas assets.
700 billion, that's a staggering number. An entire sector managing capital flows equal to the whole country's economic output.
I mean, just think about that. So you can think of the insurance sector as this giant government-sanctioned suction pump.
A suction pump, okay.
When an insurer buys an unhedged U.S. dollar asset, like a U.S. corporate bond, they have to sell Taiwan dollars and buy U.S. dollars in huge volumes.
So that flow is constantly sucking TWD out of the market.
Constantly. It acts as a structural drain that just absorbs the country's trade surplus and stops the TWD from appreciating too quickly. They are, in effect, funding the U.S. bond market with Taiwan's export dollars.
So that's the supply side of it. But what about the demand? What drives these insurers to just keep buying so many unhedged dollar bonds?
That's where the unique geopolitical situation comes in. That risk encourages wealthy Taiwanese to actually prefer buying dollar-denominated insurance policies.
So they see it as a hedge, a safe haven asset in a stable currency.
Exactly. And that customer demand creates this powerful incentive for the insurers to keep expanding their foreign asset books, which keeps the downward pressure on the TWD.
So if I'm understanding this right, an affluent family in Taipei buying a retirement policy in U.S. dollars is, without even knowing it, part of the national currency management strategy.
That's the self-perpetuating cycle.
Yeah.
Customer preference becomes de facto national policy.
And this impact is so big, the regulators have to be involved.
Oh, they're deeply involved. Taiwan's financial regulator, the FSC, is actively managing these flows. They're basically treating the financial health of the insurance industry as a currency management tool.
And we saw that really clearly in late 2025 with those accounting rule changes. What did those rules actually do?
It was a very technical change, but incredibly effective. They pushed through rules that let insurers recognize currency losses on certain bonds over time instead of all at once.
Okay, break that down. What kind of losses?
So these are bonds they plan to hold to maturity. But if the TWD strengthens, suddenly all the dollar assets they hold are worth less in TWD terms. That creates a big hole on their balance sheet.
So if the TWD starts to climb, the insurers immediately feel this pressure on their capital.
Precisely. And before this rule change, a rising TWD would force them to rush out and buy expensive hedges.
Which means buying TWD and selling USD.
Right, which makes the TWD even stronger. It completely undoes the policy goal.
So by letting them spread out the recognition of that loss, the regulators are easing that immediate pressure.
They're giving them breathing room. It reduces the need for them to buy hedges right now, which helps maintain the structural weakness of the TWD. The takeaway is clear. Managing the Taiwan dollar is completely tied up with managing the stability of the insurance sector.
Which brings us to the final part of this. For you, the investor listening, what do you do with this knowledge? How do you invest when the plumbing is so hidden?
Well, the first thing is that volatility is the new target, especially for China. You have to assume their FX policy is about managing the pace of change, not hitting a fixed price.
And because of that custodian structure, tracking their true firepower is almost impossible.
Very difficult. It adds a layer of risk during any sudden market move.
And for Taiwan, the big risk is different. You said the TWD is prone to shocks, right? Specifically short squeezes.
That's right. The TWD market is pretty thin. It's not like the euro or the yen. So if the US dollar weakens sharply, or if there's a big shift in geopolitical sentiment.
All those insurers might rush to hedge at the same time.
Exactly. And you have this massive $700 billion asset base trying to push through a very small door. The flows can be violent. We saw a spike just like that back in May 2025.
So you have to watch the hedging cycles, not just the trade balance.
You have to watch regulation, sentiment, everything.
And then there's the political price we talked about earlier. China's managed currency and export machine. It creates this dual shock for the world.
It does. On one hand, you get a flood of cheap goods, which is disinflationary. It helps keep a lid on global inflation and interest rates, which is good for consumers.
But on the other hand,
it's incredibly damaging to the profits and the stock valuations of industrial companies in other countries who just can't compete with that pricing. It's a very tricky landscape for investors.
So to sum it all up, we have these two sophisticated, non-traditional strategies. China is using state banks and this structural opacity, this network of overseas custodians.
Right. And Taiwan is using its regulatory power over its massive insurance sector and their foreign investments.
Both are incredibly effective shields against currency appreciation.
They are. And I think when you realize that some of the most powerful economic actors are using systems designed to obscure what they're doing, using overseas accounts or domestic insurance cycles, it raises a really important question.
Which is?
How much of your own investment portfolio is designed around official numbers that, as we've discussed, may not be telling you the whole story?
Don't forget to subscribe and hit that like button.